When the market starts dropping and you don't know why, you can't predict what's happening. But what does happen is the VIX starts going higher. I'm Tom Preston, Chief Market Strategist at tastylive. And this week's Cherry Picks video, I'm going to explain why the VIX spikes higher. And wait till the end and we'll see how you can take advantage of higher volatility to do some trades. So this week's Cherry Picks was put out on August 6th, and the market had already sold off. The SPX, starting on August 1st, just started to drop. Why did that happen? Who knows? I don't really care about the why, I care about the what. And it had some pretty good drops here from Thursday to Friday. Then Monday, it really just gapped down, and over the past couple of days has bounced higher. What we saw, in other words, going back, why did this happen? I don't know. But I know what happened and could have predicted this part is the VIX spiked higher. So on the same days, August 1st, there was nothing going on. Suddenly the S&P started dropping. What does the VIX do? Which is the volatility of the SPX. It starts spiking higher. What's happening and what makes it so, or I should say relatively predictable, is that when the market, and specifically participants like hedge funds or money managers or insurance companies, pension funds, they're typically long stocks. They have long delta portfolios. When the market starts dropping like it did, sometimes they want to buy protection. One of the protective trades they put on is to buy SPX or S&P puts. When they do that, they drive up the prices. So they drive up the prices of those SPX puts because they're buying them. When that happens, it increases the VIX. What is the VIX? It is a strike-weighted average of the option prices, of SPX option prices. Okay, that's a simple way of thinking about it. And those option prices are distilled into an overall volatility for the S&P 500. When buyers come in, or even if buyers don't come in, but the market makers in the SPX think, oh, the buyers will come in, I'm going to start raising up my prices for those out-of-the-money options, both calls and puts, by the way. The option premiums get pushed up across the board. Because the VIX is derived directly from those SPX option prices, it goes up immediately. So that's what happened. When the SPX starts dropping, the VIX spikes higher. And again, I don't know why necessarily, or at least while it's happening, I don't know why the S&Ps are dropping that sharply, but I do know why the VIX is spiking. What the guys did in this week's Cherry Picks, Mike Recantine and Nick Batista put out an interesting study about what happens when we see VIX spiking higher. Okay. We examined every instance where the VIX spiked above 60 intraday over the past 25 years, occurring approximately 50 times. Over the past 25 years, it just doesn't happen very often. Most of the time, the VIX doesn't move very much. It sort of drifts around, maybe spikes higher, then comes right back down. And that's kind of what we've seen over the past few days this week. So what they showed was that 1 month later, in other words, the VIX spikes over 60. Recently it was trading for like 17, 18, and a couple of days ago it spiked above 60. So that's what they're talking about. When it spikes above 60, 1 month later, the market, the S&Ps, tend to increase 65% of the time. The average movement, when the market increases, the average gain is 9.2%. When the market declines, the average loss is 7.7%. So let's recap this and make sure you understand what this is. The market increases 65% of the time after, in other words, 1 month after the VIX spikes to 60 or higher. 65% of the time, the S&Ps were higher. When they were higher, they were up on average 9.2%. And the 35% of the time they were lower, they were down 7.7%. So there's upward bias. Is this a foolproof trading strategy? Not at all, okay? But when you do see the VIX spiking higher, usually it doesn't stay, it hasn't in the past anyway, stayed above 60 for very long. It comes right back down. A lot of times what happens is the people, those institutions that are just sort of perpetually long stock might see that as a buying opportunity, or individual investors see that as a buying opportunity. Step in, start buying stocks, that pushes the S&Ps up and the VIX goes back down. There's this upward bias. And then they drill down a little bit, even after one day. August 5th of 2024, this happened just a couple of days ago. One day after, the S&Ps were up 9%, or 0.9%, excuse me. Let's go back to December 5th, 2008, back when we had the crash of 2008, 2009. One day after, December 5th, when the VIX spiked above 60, 1 month later, or one day after, the S&Ps were up 3.8%. 2 days after, they were up 1.4%. 1 week, and then 1 month, they were up 3.8. There's this upward bias. So when you start to see panic in the markets, when everybody is afraid and everybody's puking their positions, oh my gosh, the world's falling apart, sometimes it can be a smart thing to get long the market. Now, I wouldn't just go out and buy stocks necessarily, that's me. I would do a defined risk trade like a short put spread or a long call vertical, something like that in case the market does continue to drop. When you see VIX spiking higher, remember this information, remember this data, and you might be able to trade on it. The guys also pointed out some of the biggest movers in the S&P 500. Interestingly, they point out, they did an evaluation of the S&P 500 implied volatility skew. Remember, skew is the implied volatility of the options at different strikes, and it's a curve typically. In other words, it slopes upward. That's the skew. And they say even though the VIX has come down from yesterday, options are still priced significantly higher than they were a few days ago. Let's take a look at the chart and we'll see why. So here, the VIX was trading at, 16, 17 or so, spikes higher. And today, as the time of recording this, it's about 21, 22. So it's about 40% higher than it was last week. That increase in volatility means option premiums are that much higher. Okay. What the guys point out is that even though the VIX has dropped, despite the reduction in the VIX, the demand for options suggests that investors still expect substantial price movements in the S&P 500. Yeah, I mean, that's basically what it means. And they're pointing out that the put skew, the red dots here versus the call skew, which is the blue dots, there's much steeper, much more put skew than we've seen in the past few months. So typically, I don't have this on the graphic, but typically we'll see where I'm moving my cursor, it'll be down below here. And this call skew will be like this, kind of sloping out like that. So both options are much higher than they used to be, or at least they have been since last week. So both calls and puts are richer, and the put skew is relatively steep compared to that. People or the market still anticipates some downside. So for two trade ideas, what they're looking at is an iron condor in the SPY. And this is a neutral trade. If you think the S&Ps are going to surprise everybody and not move very much at all, the volatility says they're going to move a lot. People are panicking. People are, thinking, oh my gosh, what's going to happen? An iron condor says, probably not. It's probably going to stay in a range for a while. So what they're doing is looking at 45 days to go in the SPY. They're looking at a 20-point iron condor. Let's take a look at that. So we go up here. Go to the trade page, type in SPY, and we'll see what the guys are looking at. They bought the 480, sold the 500 puts, and then on the call side, 555, 575. Let's take a look at that. 555, 575. And they collect a credit of about $5. The trade right now is $4.95. They're saying it was about $6. So it's come in a bit since they looked at this trade. I like to get a third of the width of the strike. So so if it's 20 points wide, maybe $7 or something like that. Credit is $7. The other thing that I might adjust on this trade is the buying power requirement, which is $1,500. That might be a little bit steep for a smaller sized account. What I would do is, because the S&P volatility is still relatively high, I'm going to push this down to, let's say, and this is how I find trades. So I leave the long strikes as they are, and I just move these up to make them 10 point wide, 10 points, as opposed to 20 points. I'm not really getting a third of the width of the strikes. I'd like to see $3. Let's bring the short strikes up. Let's go to, let's do the 500, and let's say 5 points. Let's see if we get 5 points strikes on the call side. And selling the option, it has about $8 credit. Let's take a look at the 536. Again, trying to match up the strikes, the calls, and the puts, where the credits are basically the same. So let's do the 537, and let's go down to move this strike down to the 542s. So 5 point spread. Again, that's a too high a credit now, so let's move this out. Let's go down to where they're about 6.5. Let's do 3 points. Let's do a 3 point iron condor. And folks, this is how I find trades. Yeah, this is a little bit more my speed. So it is a 3 point iron condor, 3 points between the strikes. Maximum loss is $163. And it only requires about $163 of margin requirement to do this trade. 65% probability of making half its profit before expiration, generates $1.50 of theta. This is a trade that if you thought the SPY was going to trade between 493 and 546 over the next, let's say, month, because you probably wouldn't necessarily hold this to expiration, this is a trade you might consider. Okay, and again, you can adjust the strikes accordingly. You can go 2 point wide and see how that treats you. Yeah, you could even do 2 point wide, reduce the risk, increase your probability of making 50%. That's how you approach these trades. Let's look at the next one the guys point out. And again, this is due, you look at an iron condor to sell premium because the VIX is so high. Nvidia is down nearly 30% from its highs post split. Yeah, all the chip stocks have been getting whacked. With vol exploding, call buyers are experiencing their first vol crush, but there's still potentially more to come. So yeah, I would restate that a little bit. Vol crush tends to mean when volatility is coming down. But with the call buyers, people who are buying calls, to buy a call is a bullish trade. The problem is that it has negative theta, a relatively low probability of profit, and as the stock rallies back, volatility begins to drop. That's the vol crush. So when the stock goes up and volatility starts coming down, those long options, the premium just gets sucked out of them because volatility is dropping. That's your vol crush. If you want to lean slightly long into earnings, a wide short put spread is an interesting way to play the upside in a volatility contraction. Short the 85-100 put spread trades around 467. Let's take a look at that with 45 days. The 85-100 in Nvidia, and just to show you what they're talking about, Nvidia has just been crushed, but most of those chip stocks have been, no surprise there. So they go into what would be now, and the earnings are coming up at the end of August, so just be aware of that. You have to be willing to take risk through earnings. So they're selling the 100 and buying the 85. Yeah, that's 71% probability of making 50% of his max profit. Max loss is about $950, which again, maybe a little bit steep. You could push this down, and let's do this 3 point wide, 2 point wide here. And one of the hard things about Nvidia is the strikes are not uniformly equidistant. Let's do this 3 point. This isn't bad. It doesn't quite get 1/3 the width of the strikes. Only gets 82 credit, but this is how you experiment with strikes. The max loss is only 218 as opposed to 900 and change, right? So it's a lot smaller. Margin requirement is only the max loss, which is about $218. So you can do this in a smaller account. Probability of making 50% of its max profit, which would be about $42, is 80%. That's not bad. It generates 62 cents of positive theta. And that's what you get when you look for products, stocks, ETFs, indexes that have high implied volatility. You get rewarded for taking risk. If you want to get these cherry-picked emails delivered straight to your inbox, or my daily cherry bombs with trade ideas to your inbox every day, click on the link below.